Hey guys, in this week's educational series, I will be explaining one of the most watched data by central bankers all over the world, inflation data. My name is JT and in this video, part 1 on the topic of inflation, I will be explaining the economic indicator called Consumer Price Index or the CPI. If you don't already know, the Consumer Price Index is a big deal nowadays, making it one of the most crucial data watched by Forex traders all over the world. So obviously, it is important, but why? And how do we interpret Consumer Price Index? Let's break it down in this video. Firstly, the Consumer Price Index is one of the most popular measures of inflation. Specifically, it measures the average change in retail prices over time for a basket consisting of more than 200 categories of assorted goods and services, which are then divided into 8 major groups covering from housing to transportation to education. So how do you read the CPI? It is an index. Means that it has a base year and calculations are made relative to this base year. In this base year, let's say year 2000, the index score would be 100. In a subsequent year, in year 2001, if a score jumps from 100 to 101, this means that the inflation is at 1% per annum. If it jumps from 100 to 105 in 2001, this means that the annual inflation rate is 5% instead. Quick question. If the annual inflation rate is 5% per annum, how long does it take for prices to double in an economy? If your answer is 20 years, think again. The answer will be given at the comment section of the video. So back to the topic. CPI is released on a monthly basis and as the name suggests, it tracks how much consumers pay for goods and services. But why is CPI so important to central bankers? The reason is because, as mentioned in the first economic indicator video, central bankers are largely concerned with how much consumer prices are actually growing, plus the business's profit levels. And the CPI is a very telling figure. Apart from informing you on how much are consumers paying for goods and services, the CPI is used as a gauge for cost of businesses, corporate investments, as a gauge for quality of life, and an important number for labour unions and government as well to determine social policies. It's no wonder that inflation targets, CPI being a core part of it, becomes the most chosen mandate for central banks. This brings us to the next point. How can you use CPI for Forex trading? You might recall in my first video where I mentioned that the Federal Reserve System, which is USA's central bank equivalent, does not like a high inflation rate. In fact, the target inflation rate is exactly 2% per annum for the Federal Reserve System. If it's too high, they will do something to lower it, and vice versa is true. So I'm going to explain to you why they target 2% and not lower. I mean, if inflation means that my lunch is going to be more expensive 1 year from now, I should want it to be as low as possible, right? Well, not quite. Allow me to explain. Let's understand how inflation come by in the first place. There are two main schools of thoughts here concerning the source of inflation. The first explanation, a theory by Milton Friedman, is that inflation is a monetary phenomenon. When governments print money excessively, there are too much money chasing too few goods. And there you go, prices go up as a result. The second explanation is that of John Maynard Keynes. Simply put, supply and demand. When the economy demands more goods, prices go up. Similarly, when the prices produces less goods, prices go up as well. The combination is the most lethal. So is inflation good or bad? It's actually both. Inflation is good when at stable levels it allows asset prices to increase and stock investors are happy, especially if it's the second case where demand pulls up prices. Companies' earnings growth and tax revenues for the government increases, but it sometimes increases for basically no reason except for price inflation. So it's not difficult to see the bad part of inflation. It does not reflect real growth, but a nominal growth, meaning to say while prices increase, there is no actual growth in standards of living. This is especially true if the case for inflation is a monetary phenomenon as explained by Milton Friedman. In some cases, you have a runaway inflation or hyperinflation where prices becomes not twice, not 3 times, but 100, 1,000 times more expensive within a matter of days, and some cases even hours. In extreme cases, you will see this right here happening. Literally everybody is $1 billion richer, but of currency that has no more value. In that scenario, the value of currency becomes worthless and central banks will have to do their best not to allow that to happen by keeping inflation in check. When inflation rate or CPI goes up more than 2%, they will administer a series of policies to bring inflation down. These series of policies may have names such as contractionary or tightening policies. Bank interest rates are set higher, and when they do that, currencies tend to become stronger, allowing traders to exploit the strengthening move in Forex. Now, what happens when inflation goes the other way around? What happens when it goes below 2% or even to a negative rate? In a case where inflation becomes lesser than 2%, central banks will administer the opposite of tightening, which is easy money, or to have accommodative policies. This is characterized by lower interest rates and money becomes easier to attain. With all this extra money go around in the economy, CPI will go up to 2% in no time. Sometimes the economy becomes extra bad and business activities becomes slower than ever, causing prices to go lower instead of higher. When CPI registered a sustained lower score in the following year, it is officially a negative inflation. This is called a deflation. And at first glance, it is a good thing for consumers, right? But a deflation can actually be as bad, if not worse than a high inflation rate. Falling prices means falling profits for companies, which in turn means that companies hire lesser and sometimes even have to slash jobs. Higher unemployment means that consumers have lesser money to spend. This results in even lesser business activity, profits slide lower. And this vicious cycle goes on and on until the economy starts picking up again. Now, the central bankers definitely do not want that. And in the case of deflation, central banks will resort to even more extreme measures of easy money. This further injection of money will lower the value of currency even more, and this is exactly what's happening right now. But that's another story for another time. In conclusion for today, the higher the CPI, the higher the inflation, and if much further away from 2%, central banks are likely to increase interest rates to start buying the currency. The lower the CPI, the lower the inflation, and central bankers are likely to decrease interest rates. You start selling this currency. This concludes part 1 on the topic of inflation. Watch this video again to understand more about inflation, and for our next video, I will explain what exactly is happening to today's global economy in our next episode of the Alpha Play educational series. Can knowing this make money in the Forex market? The answer is a big resounding yes, but sometimes looking at just the CPI is not going to bring you very far. You must be able to look at the bigger picture, and that essentially is fundamental analysis. Learn how you can make use of fundamental analysis in our FX Fundamental Analysis and Market Sentiment Masterclass and trade the market with clarity. My name is JT. I hope you have enjoyed this video. I will see you in our next installment of the Alpha Play educational series.